Welcome to the deep dive. Today we're tackling a subject that, well, it impacts every wallet and every nation. The fundamental rewiring of the global financial system.
It really does. It's huge.
Yeah, and this isn't just about, abstract tech or boring economics. It's about these powerful interlocking forces. Things like decentralized finance, artificial intelligence, new ways of living even, and the sharpening geopolitical contest.
Absolutely. A contest for control.
Exactly. Control over the very infrastructure of our financial future. This whole rewiring thing, it affects how money works, maybe where you live, who holds power. So let's dive in.
It's definitely an immense transformation. You could argue it's more profound than anything since Bretton Woods ended.
Wow, that's a big statement.
Well, we're seeing this shift on so many levels. Technology, sure, but also social dynamics, politics. It's really reshaping how value is, created, moved, governed globally.
A seismic shift, no doubt.
Yeah.
So, okay, to really get where we're going, maybe we should quickly look back. What is money, fundamentally?
Good starting point.
Because if we're talking rewiring money, it helps to remember what it does. Store of value, means of exchange, unit of account.
Right. Those three core roles, exactly. And what's changed over time, from shells to gold to paper and now code, is that underlying technology of trust.
Technology of trust. I like that.
Yeah. Early money, commodity money, had value in itself. But then we moved to fiat money. Its worth comes from collector belief in the issuer, usually a government.
But that belief, historically, it wasn't always solid.
Not at all. Early paper money, like in the Tang Dynasty, often unstable. Governments, well, they got tempted to print too much.
Leading to hyperinflation, like Germany after World War I.
Precisely. A total collapse of that trust. Modern finance tried to fix this with central banks, institutionalizing that trust.
Okay, and then came 2008, financial chaos. And out of that emerges this, radical idea.
Radically different, yeah.
Satoshi Nakamoto, whoever they are, drops this white paper. An electronic payment system based on proof, not trust. Transacting directly, no middleman.
That was the core. Cryptographic proof instead of trust.
So what was the critical innovation there? How did it actually work?
It solved the double spending problem, making sure you can't spend the same digital coin twice without a central bank watching over it.
Ah, okay. And how?
Through a decentralized network. Everyone agrees on the transaction history together, and the implication was profound. You could suddenly, programmatically, unbundle money's functions.
Unbundle, meaning?
Meaning different digital assets could specialize. So Bitcoin, right, despite its volatility, some see it as digital gold, store of value.
Not really for buying coffee.
Not usually, no.
Yeah.
Whereas stablecoins, they popped up almost purely as a low volatility way to exchange value within the crypto world.
So specialization, driven by proof instead of trust.
Exactly. And that just opened the floodgates, this Cambrian explosion, you could call it, of new financial tools.
An explosion that really kicked off January 3rd, 2009, the Bitcoin Genesis block, birth of crypto, birth of blockchain.
The first successful one, yeah.
So how did Bitcoin pull off this trustless system? You mentioned proof.
Right. It uses proof of work. Essentially, powerful computers, miners, compete to solve this incredibly complex puzzle.
The energy use there is huge, right? I read comparisons to entire countries.
Oh, yeah. It's massive. Back in 2018, it was already using more energy than Hungary. But that energy, that computational work, is what secures the network without needing a central authority.
Okay, so energy buys security and the transactions.
Each coin is like a chain of digital signatures. Every transaction gets broadcast, miners solve the puzzle, add a block of transactions to the chain, creates this public, unchangeable ledger.
But it's slow, right? And energy hungry. Not great for everyday payments.
Exactly. Its limitations. Low transaction throughput, high energy cost.
So if Bitcoin was digital cash, then Ethereum, that was pitched as the world computer, Vitalik Buterin 2013 white paper, what made it different?
Ethereum's big leap was its scripting language. It was Turing complete, meaning, in simple terms, developers could build almost any kind of program right onto the blockchain, not just transactions.
Ah, so that enabled smart contracts.
Exactly. Self-executing code, agreements that run automatically on the blockchain. That turned the blockchain from just a ledger into this global settlement layer for programmable logic.
Which led to dApps, decentralized applications, and DeFi?
The whole decentralized finance ecosystem, yeah. Lending, borrowing, trading, all running on code. And Ethereum also moved away from that energy-intensive proof of work.
Right, the merge to proof of stake.
More
efficient.
Much more efficient.
Okay, so Ethereum opens up this world, But you mentioned earlier the blockchain trilemma. Scalability, security, decentralization, hard to get all three. Where did Ethereum land on that?
Well, like Bitcoin, early Ethereum prioritized security and decentralization, which meant scalability suffered. It couldn't handle massive transaction volumes cheaply.
And that's where Layer 2 solutions come in, L2s.
Exactly. They're built on top of Layer 1 blockchains like Ethereum. They handle most transactions off the main chain, faster and cheaper.
And then they report back to the main chain.
Yeah, they periodically submit summaries or proofs back to Layer 1 for final security and settlement. They basically rent Layer 1 security.
Okay. And there are different types, optimistic and ZK.
Right. The two main flavors. Optimistic rollups, like Arbitrum, Optimism. They assume transactions are valid initially, faster, but there's a challenge period, a waiting time.
A fraud check window.
Sort of. And then you have zero-knowledge rollups, or ZK rollups. Think ZK Sync, Starknet. They use fancy math, cryptography, to prove validity instantly.
Sounds more secure, faster finality.
Generally, yes. But they're more complex to build. And here's a catch with many L2s. They often rely on centralized sequencers to order the transactions before they go back to L1, which, ironically, reintroduces a single point of failure, something blockchains aim to remove.
So decentralization isn't always fully decentralized.
It's often layered, complex trade-offs.
Right. And you mentioned that Cambrian explosion. It's clear cryptocurrency isn't broad enough now. Even the IRS says digital assets. Can you give us a quick tour of this bigger spectrum?
Sure. Digital asset basically covers any value recorded on one of these cryptographically secured ledgers. It's a wide spectrum.
From Bitcoin on one end?
Yeah. Permissionless, anyone can use it, like Bitcoin, all the way to the other end, where you have things like central bank digital currencies, which are centrally issued, permissioned, state-controlled.
And lots in between, like stablecoins. These seem crucial for actual use. Why did they emerge?
They popped up purely because crypto, like Bitcoin, is so volatile. You can't easily price things or transact day-to-day if the value swings wildly.
Just stablecoins aim for stability, pegged to the dollar, usually?
Usually the U.S. dollar, yeah. Makes them useful as a medium of exchange within the crypto world. And there are three main types you should know.
Okay, lay them out for us.
First, fiat collateralized. These are the big ones, like Tether's USDT, Circle's USDC. They're backed, supposedly, by reserves of actual fiat currency or things like U.S. Treasury bills, centralized claims.
Supposedly. Sounds like there's some controversy there sometimes.
There has been, yeah. Transparency around reserves is key. Second type, crypto collateralized, like MakerDAO's DAI. These are backed by other crypto assets, locked up in smart contracts, usually over-collateralized to handle volatility.
Okay, backed by crypto. And the third?
Third was algorithmic stablecoins. They tried to maintain their peg using clever algorithms who adjust supply. Didn't need direct collateral.
Was algorithmic? Past tense.
Pretty much. This model proved, well, inherently fragile. The collapse of Terra USD, UST in 2022 was spectacular proof. Wiped out tens of billions, largely discredited now.
Ouch. So the main ones are backed by real-world assets or crypto.
Right. And that reveals this profound paradox. This huge DeFi ecosystem promising decentralization. It's actually built on a bedrock of centralized institutions holding traditional assets.
You mean the companies issuing the fiat-backed stablecoins?
Exactly. Their value depends on traditional banks holding dollars or T-bills. So if a bank like Silicon Valley Bank wobbles, as it did,
it directly hit USDC's reserves and shook confidence.
Instantly. It showed how interconnected it all is. Decentralization, turns out, relies heavily on centralization.
That's a critical point. Decentralization built on centralization. Okay, moving beyond currency-like things. NFTs, non-fungible tokens.
Yeah.
Unique, right?
Totally unique. Unlike Bitcoin, where one coin is the same as another, each NFT is distinct. It's a digital certificate of ownership on the blockchain.
Famous for digital art, the punks, the apes, but it's broader.
Much broader. Think ownership of music tracks, virtual land, event tickets, collectibles, anything where uniqueness matters. Plus, they're programmable.
Meaning you can code rules into them, like royalties.
Exactly. Automatic royalty payments to creators every time it's resold. That's a big deal. And speaking of bridging worlds, another huge trend is tokenizing real-world assets. RWAs.
Taking physical stuff and putting it on the blockchain.
Essentially, yeah. Creating a digital token that represents ownership of, say, a piece of real estate, a share of a bond portfolio, fine art, even U.S. Treasury bills.
What's the advantage there?
Big advantages. Makes illiquid assets, like real estate, easily tradable 24/7. Allows fractional ownership. You could own, say, $100 worth of a skyscraper. More access.
And transparency. Efficiency.
Yeah, immutable records, automated payments via smart contracts. Because these often look like securities. Big institutions. BlackRock, Fidelity, Citi are very interested. The market's projected to hit trillions by 2030.
Trillions, okay. And then finally, the state fights back or joins in with CBDCs, Central Bank Digital Currencies.
The state's response, exactly. CBDCs are digital versions of a country's fiat currency, a direct liability of the central bank.
So not like Bitcoin, centralized, state-controlled.
Completely centralized, state-controlled, designed to work alongside or maybe even replace physical cash someday. And it's happening everywhere.
How widespread?
Over 130 countries. That's like 98% of global GDP.
Yeah.
Exploring, piloting, some have even launched.
Why? What's the motivation?
Varies a lot. Improving payment systems, financial inclusion for the unbanked, countering private crypto or foreign currencies taking over.
Like avoiding dollarization or cryptoization.
Exactly. And maybe even getting new tools for monetary policy. China's digital yuan, the ECNY, is the biggest pilot right now. So yeah, if you map it out.
Decentralized store of value speculation mostly. Bitcoin.
Centralized exchange medium, USDC, USDT.
Unique ownership proof.
CryptoPunks.
Fractional ownership, investment. Tokenized T-bills.
State-issued centralized payment tool. ECNY. That's the landscape.
Okay, fantastic overview of the new monetary DNA. But these assets don't exist in a vacuum. They're being turbocharged by other forces. Let's talk accelerants, starting with AI.
Right. Artificial intelligence.
How is AI, this sort of alchemical agent, you called it, changing how finance actually works with these new tools?
Yeah, alchemical agent feels right. It's turning raw data into intelligence, security, automation across this whole digital asset world. Its impact is everywhere. Like in trading. I hear about algorithms processing insane amounts of data.
Oh, absolutely. Crypto markets run 24/7. They're volatile. Perfect playground for AI. Algorithms ingest everything, price history, on-chain data, social media sentiment, news headlines.
In real time.
Instantly. They use things like LSTM networks for price prediction, CNNs for chart patterns, NLP natural language processing to read the market's mood from text.
Faster than any human.
Way faster. But it's not just speed. AI can decode the psychology driving the market at scale, spot patterns humans miss, removes emotional bias. It's fundamentally changing trading. And beyond trading, AI is crucial for security and risk management. It's a symbiosis.
How so? Blockchain and AI working together.
Exactly. Blockchain gives you that immutable record. AI analyzes it for threats. Think AI spotting weird transaction patterns, flagging illicit addresses, untangling complex money laundering like peel chains.
Companies are doing this.
Yeah, firms like TRM Labs use AI to monitor blockchains for fraud, sanctions busting, terrorist financing. That's why regulators are pushing hard now for AML-CFT rules, KYC. Know your customer.
Makes sense. What about auditing smart contracts? Those things control billions. A bug could be disastrous.
And traditional audits. Slow, expensive, humans miss things. AI auditing is a game changer.
How does it work?
AI tools trained on tons of code and known bugs, things like reentrancy attacks or integer overflows.
Nasty bugs that let people steal funds.
Right. The AI scans new contract code automatically, flags potential vulnerabilities in minutes, faster, cheaper, more scalable security. But there's a dark side, the AI security dilemma.
That's ominous.
It is. The same AI that defends can be used by attackers to find new bugs, probe weaknesses at incredible speed, and if everyone relies on the same few AI audit tools...
A bug in the auditor could be catastrophic.
Exactly. Systemic risk. It becomes this high-stakes arms race. DeFi's stability might literally depend on who has the smarter AI, the builders or the breakers.
Wow. That AI arms race. That's the chilling thought for anyone using DeFi. Okay, shifting from security... AI in governance, DAOs.
Decentralized Autonomous Organizations, DAOs.
Right. What are they, quickly, and how is AI changing them?
A DAO is basically an organization run by code, by smart contracts, decisions made by token holders voting. But human DAOs often struggle. Voter apathy, slow decisions.
So AI steps in.
That's the idea. AI could automate analyzing proposals, manage the Treasury's funds optimally, flag malicious proposals trying to sneak through.
It could even learn and improve the rules over time.
Through reinforcement learning, yes. An AI DAO could evolve its own governance. It's kind of the ultimate endpoint of disintermediation, pushing automation to its limits.
A truly autonomous organization. Fascinating, slightly scary. Okay, another accelerant. Moving from tech to people. The untethered economy.
Digital nomads.
Yeah, people working remotely, living anywhere.
How has crypto fueled this?
Well, crypto offers value that's censorship-resistant, easy to move across borders, not tied to one country's banks. Perfect for nomads. So they move where the rules are friendly. Crypto migrations.
Exactly. Capital and talent flows to jurisdictions with favorable regulations and, crucially, favorable taxes for digital assets.
And we're seeing actual crypto tax havens emerge. Where are we talking, roughly, in 2025?
Oh, yeah. Places like Portugal, traditionally offering tax-free long-term crypto gains. Malta, no capital gains on long-term holds sometimes. The UAE, especially Dubai, zero personal income or capital gains tax.
Singapore, too. El Salvador.
In Singapore, no capital gains tax. El Salvador, Bitcoin legal tender, tax breaks. Germany's got a one-year hold rule for tax exemption. Panama, Paraguay territorial tax systems, only taxing local income. And it's not just taxes, it's residency, citizenship.
Countries selling passports for Bitcoin.
Sort of. El Salvador's Freedom Visa, $1 million in Bitcoin or USDT, gets you citizenship. Portugal's Golden Visa includes crypto-friendly investment funds now. Vanuatu, Antigua, and Barbuda, they're in the game too.
This must be a massive headache for high-tax countries. The old rules, residency based on days spent somewhere, territoriality, they seem broken.
They really are challenged, especially for countries like the U.S., which taxes based on citizenship no matter where you live.
And the IRS treats crypto as property. Every sale, trade, even using it to buy something is a taxable event.
Yep. Creates a huge record-keeping burden. But yeah, the broader trend is individuals using tax arbitrage to minimize their burden, eroding the tax base of traditional high-tax nations.
So what's the government response likely to be? They won't just let this happen.
No way. Expect tighter rules, stricter enforcement of residency definitions, maybe exit taxes if you renounce citizenship, and definitely more international cooperation, like the OECD's Common Reporting Standard, trying to track these flows.
So the sovereign individual versus the sovereign state.
A collision course, definitely, in this digital age.
Okay, final accelerant, the convergence of DeFi and TradFi.
Yeah.
Traditional finance.
Yeah.
It's not DeFi replacing TradFi anymore.
No, that narrative shifted. It's more like TradFi is selectively adopting DeFi's tech. Co-opting it, maybe?
Why the change?
DeFi's potential is just too big to ignore. Openness, efficiency, lower costs, faster speeds, financial inclusion. TradFi wants those benefits.
So institutions are jumping in.
Actively. Projections suggest a quarter of global custodians, the big guys like BNY Mellon, State Street, will offer institutional-grade crypto custody by 2025.
Are there concrete examples of banks using this tech?
Sure. JP Morgan's Onyx platform uses a private blockchain and their JPM coin for instant settlement. They claim an 80% reduction in settlement times. Citi's working on tokenized deposits. HSBC has tokenized gold for clients.
And those real-world assets, RWAs, are key to this.
The primary bridge, really. That projection of a $10 trillion RWA market by 2030, that's mostly traditional capital flowing onto blockchain rails.
But risks. You mentioned the decentralization illusion.
All right.
What are the systemic dangers here?
Crucial point. The Bank for International Settlements, the BIS, warns that just automating doesn't get rid of centralization. Power still pools with developers, big token holders. Accountability gaps remain.
And the specific risks.
There's severe technical risks, smart contract bugs. Think the DAO hack in 2016, Terra Luna in 2022, billions lost. Financial risks, huge leverage in DeFi, crazy volatility, liquidity mismatches, without safety nets like deposit insurance, illicit finance risks. Pseudonymity attracts money laundering, terror financing. Regulators are cracking down hard with AML, KYC.
The elephant in the room, environmental impact.
Still a huge issue for proof-of-work chains like Bitcoin, staggering energy use, Poland-sized footprint, mostly fossil fuels in the U.S. One Bitcoin transaction's energy could power a U.S. home for weeks, or equals 1.5 million Visa swipes. So yeah, this convergence, that's a double-edged sword. TradFi uses the tech but doesn't get replaced. Concentration of power, systemic risk. It might just get repackaged, relocated, not eliminated.
Okay, let's pull back and look at the big picture, the geopolitical chessboard. How does all this tech shake up global power, specifically the U.S. dollar's dominance?
Right, the dollar's exorbitant privilege. Decades as the world's reserve currency, giving the U.S. huge leverage, sanctions power. But there's this growing de-dollarization talk now.
But here's the weird thing, the paradox. Those private stablecoins, USDT, USDC, they're pegged to the dollar. Aren't they actually helping the dollar?
It seems counterintuitive, but yes, in many ways they are reinforcing it. They dominate crypto trading. Over $200 billion market cap. trillions in volume.
Oh.
They're a direct gateway to dollar exposure for people globally, especially in places with high inflation like Argentina, Turkey, Nigeria. They bypass local controls, access dollars easily, creates huge new organic demand for dollars.
So it extends the dollar's reach.
City strategists think so. Plus, the issuers have to buy massive amounts of U.S. Treasury bills for their reserves, more demand for U.S. debt.
Okay, so if private digital dollars help the U.S. dollar, what's the real challenge then? Where does de-dollarization come from?
The real challenge is coordinated state actors, geopolitical rivals. The U.S. using sanctions heavily incentivizes countries like China, Russia, others to build alternative systems.
And we see evidence of that.
Clear evidence. The dollar's share of global central bank reserves is down, from over 70% in 2001 to under 60% now in 2023. And more energy trade, especially involving Russia, China, India, is happening in other currencies: yuan, rubles, rupees. So the future isn't just Bitcoin versus dollar, it's fragmenting. We're likely seeing 3 overlapping ecosystems emerge.
3 systems.
Yeah. One, a U.S. dollar-centric system, but turbocharged by these private regulated stablecoins. Think the U.S. leaning into market-led innovation, like with the Genius Act. 2, a China-centric system. Top-down, state-led. They banned private crypto, pushing their own digital yuan, the ECNY, hard, bilateral deals. And 3, a multipolar decentralized system. This includes efforts by blocs like BRICS for non-dollar trade, plus maybe truly decentralized assets like Bitcoin used as a hedge by some states.
And the main contest is U.S. versus China.
That's the core geopolitical tension driving much of this.
Okay, let's zoom in on BRICS. Now, BRICS 10, right? With Egypt, Ethiopia, Iran, UAE joining. They seem like the most organized challenge. What's their main aim?
Their primary goal seems to be building sanctions-proof financial plumbing. It's less about killing the dollar globally, more about creating alternatives so the U.S. can't cut them off. A multipolar world. Defensive, really.
And how are they doing this? Using local currencies more. This BRICS pay thing.
Exactly. They claimed at their last summit, July 2025, that around 90% of trade between members is now settled in local currencies, up from maybe 65% a couple of years ago.
Wow. Like Russia selling oil to China for yuan.
Yep. Russia to India in rupees, too. India trading with the UAE in rupees. Expanding currency swap lines to bypass the dollar. And the long-term goal is BRICS Pay.
What's that aiming to do?
Link their domestic fast payment systems, India's UPI, Brazil's PIX, etc. Maybe handle cross-border CBDCs eventually. A direct alternative to SWIFT, the main global messaging network.
But it's slow going.
Very slow. Still under development. No pilot expected before late 2026 at the earliest.
Okay, so if they're pushing local currencies, why isn't a single BRICS currency happening? You sure talk, but it seems unlikely.
Immense obstacles. Just huge. First, economic divergence. China's economy is massive. Ethiopia's tiny. Inflation rates all over the place. How do you set one monetary policy? Impossible.
And politics, sovereignty.
Exactly. Giving up monetary control, that's fundamental. India, Brazil, South Africa wouldn't easily agree. Plus, China wants the yuan to be international. That competes with a neutral BRICS currency.
Technical hurdles, too.
Different capital controls, no shared deposit insurance, incompatible systems. Building that union would take decades. So the focus is practical. Alternative settlement, not a new global reserve currency, but it does fragment the world financially.
Right. Fragmentation. Okay, let's loop back to CBDCs, the state's digital hand. What's driving this global race? We know 130-plus countries are involved.
Modernizing payments is a big one, especially costly cross-border ones, financial inclusion, but also, countering private crypto or foreign currencies, dollarization or cryptoization, giving people a safe public digital option.
And maybe more policy tools.
Potentially. Things like negative interest rates, maybe faster stimulus delivery. Those are controversial aspects.
You also said the CBDC models represent a clash of values. How does the tech itself embed politics?
The design choices directly reflect a nation's priorities. State control versus individual privacy. It's not neutral tech.
So contrast the models for us, China versus the U.S. versus Europe.
Okay. The Chinese model, ECNY, they call it controllable anonymity. Maybe more privacy than Alipay for small buys, but the People's Bank can see everything. It's a powerful tool for surveillance, capital controls, enhances state power, top down.
And the U.S.
The U.S. model. Basically, rejection of a retail CBDC, strong bipartisan pushback over surveillance fears, financial censorship worries, legislation aims to block the Fed from issuing one directly to people.
So the U.S. strategy is?
Market-led. Encourage private sector, regulated dollar-backed stablecoins, keep the government out of individual transactions.
And Europe. The digital euro.
The European model, trying a middle path, officially emphasizing privacy as core. But the challenge is designing something efficient that also meets strong EU data privacy laws. It's tricky.
What does this divergence mean geopolitically? Fragmented payments.
Almost certainly. You won't have one global digital payment system. You'll likely have politically aligned blocks. A digital yuan zone, a digital dollar stablecoin zone, maybe others.
And interoperability, linking them.
Probably limited to countries with shared values, shared politics. Financial tech becomes tied to ideology. Choosing how you pay becomes a geopolitical statement. And yes, it could weaken reliance on SWIFT and the dollar over time.
Okay, crystal ball time. Let's look at, say, 2035. What does this remapped financial world actually look like?
Well, I think we'll see these trends mature, the sort of Wild West days of crypto, mostly over, replaced by a more structured, regulated, institution-heavy market.
AI is just standard plumbing by then.
Core infrastructure, yeah. Not novel anymore. And that multipolar contest, it'll be clear, distinct competing financial blocks.
What about actual adoption? Will most people be using this stuff?
Seems likely. Crypto ownership is already significant. In the U.S., late 2024, it was like 27% of adults, 70 million people. Global market cap projections for crypto are over $11 trillion by 2030.
Driven by institutions.
Largely. That survey showing 83% of institutions planning to increase crypto allocation, that's the signal. It's becoming a normal portfolio piece, not just speculation. And AI and finance, it'll be everywhere. That market's projected growth, nearly $200 billion by 2030, over 30% a year. That's transformative. Autonomous finance.
Meaning AI runs core functions.
Yeah. By 2030, things like forecasting, reconciliation, reporting, largely autonomous AI agents. EY thinks firms using AI could cut operating costs 20% by 2026 already.
But regulations will differ wildly. You called it the Great Divergence.
Exactly. A real patchwork. It forces companies to navigate, maybe even choose sides.
So the U.S. gets its framework. Clarity Act, Genius Act.
Expected in 2025 should clarify SEC, FTC rules for stablecoins, favoring private innovation, blocking a retail CBDC.
Europe implements MiCA.
Full implementation 2025-26. Harmonized EU market, single license, strict rules, especially for stablecoins, might push some out, attract others who want certainty.
And BRICS all over the place.
Highly fragmented. China, ban private crypto, push ECNY. Russia, digital ruble domestically, maybe allow crypto for bypassing sanctions internationally. India, tax crypto heavily, ban it for payments. Brazil, crypto-friendly, but tightening taxes.
This regulatory fragmentation, it's like a digital iron curtain.
In a way, yeah. Capital and innovation flow where rules are clearest or lightest creates strategic challenges for global firms.
Okay, bottom line then, the big question. Does the U.S. dollar lose its top spot in the next decade?
The consensus forecast, probably not broken in the next 10 years. The dollar's advantages, deep markets, network effects, now boosted by regulated stablecoins, are just too strong for a quick collapse.
But it erodes, contested.
Definitely contested. Its dominance weakens at the margins. The world in 2035 isn't a single globalized system, it's fragmented.
Those three corridors you mentioned, U.S.-led, China-led, BRICS non-aligned.
That's the likely landscape. U.S. bloc, stablecoins, TradFi. China bloc, ECNY, state control. And the rest, focusing on non-dollar trade settlement, navigating that fractured world. That's the defining challenge.
So to help us track this, you've got some key indicators to watch through 2035, a dashboard. What jumps out at you on that dashboard? What should listeners really keep an eye on?
Several things across categories. For de-dollarization geopolitics, watch the USD share of global reserves. If it dips below 55% consistently, that's a big signal. Also, intra-BRICS trade in local currencies, does it stay high, around 90%, or falter? Does BRICS pay launch or fizzle?
Okay. What about adoption?
For digital asset adoption, keep an eye on USD stablecoin market cap. Does it keep growing way faster than traditional payments? That shows dollar's digital reach. And tokenized RWAs crossing that $5 trillion mark by 2030 would be huge institutional validation.
Tech and social trends.
Technological social. Watch layer 2 transaction volume. If it's consistently 10x layer 1 volume, scaling solutions are working. Also, maybe a niche one, but track AI-powered DAOs. Their number and treasury size shows how far true automation is going.
And risks. How do we track stability?
Risk stability. Value lost to DeFi hacks. We need to see that number consistently decrease year over year from the billions it is now. That signals maturity. And Bitcoin's energy use, does it drop or shift demonstrably to renewables? That tackles a major criticism.
What a journey. We've gone from the nature of money to AI, DAOs, Digital nomads, geopolitical blocks, how it's all reshaping finance, payments, power. The complexity is just mind-boggling.
It really is. And this whole rewiring, it suggests the very meaning of economic independence is changing. For people, for nations.
How so?
Well, the next decade might not just be about who has the most money. It might be more about who controls the rails money moves on and who writes the rules for those rails in this increasingly fragmented world.
Who controls the rails and the rules? A powerful thought to leave us with. Thank you for joining us on this deep dive. We hope it helps you make sense of this incredible shift. Keep exploring, stay curious, and we'll see you next time.